Hello, and welcome to today's video. So today we're going to be talking to you a little bit about how to get yourself a buy-to-let mortgage. So for those of you that are new to property investing and have not invested in property yet, today we're going to be covering how to get a buy-to-let mortgage. Now, for those of you listening in at home live to the session, I'd love you guys to give us a little bit of a thumbs up, just make sure the sound is working. I believe it is. Everything should be working on our side. But this should be a really interesting session, especially if you're a new investor or you haven't got yourself a buy-to-let mortgage before and you'd like to do a little bit of a venture into the property investing world right here at home in the UK. So it should be a really good session. So I've got a couple of notes on what I'm going to be referring to. So first of all, I want to talk to you a little bit about what is a buy-to-let mortgage. Okay, what is a buy-to-let mortgage? So let me break this back first of all to what a mortgage is. So a mortgage actually derives from the French term mortier. I believe, so I've heard this, I'm sure my French colleagues and friends will be happy to clarify, but essentially it means, so mortier is until death. So a mortgage is basically a debt until death, that's the term of a mortgage. And the premise of a mortgage is what you do is you would lend against a asset of a fixed value, a house, and they will lend you a percentage of the value of that house, and essentially their money would be secured, so if anything happens, if you didn't pay your bills, they would repossess the house and get their money back that way. But you would then pay them an interest on a monthly basis for the use of their service. Okay, this is the definition of a mortgage. This is how a mortgage works. So if you have a house, you can get a mortgage. They will lend you a certain percentage of the value of the house in terms of money. Just £100,000 house, they might lend you 80%. So they might lend you £80,000, of which you can then go away and do whatever you would like to do with that money. Typically, people use it for home improvements in their own home. But when it comes to investing in property, you're going to be getting what's called a buy-to-let mortgage. Now, a buy-to-let mortgage is different to a normal mortgage in a couple of ways. Firstly, because it is catered to by lenders that specialize in working with property investors, so people that want to invest in property, and it specializes in working with people like that, as opposed to trying to work with people who are just doing it for their own home's purpose. I hope this makes sense to some of you guys. Okay, so essentially that's the first thing. Second thing is the amount that they tend to lend and the security they take tends to be a little bit different. Okay, so the amount they tend to lend for a normal home mortgage, so a mortgage you tend to get at home, you'll tend to find you can get lending of somewhere around 90%, 95% lending. And that's what a mortgage lender will lend you. They'll lend you, say, 95% on your own home, but they would look at your earnings amongst other factors to ensure that you are legitimately able to take it. Whereas for a buy-to-let, they will typically lend you somewhere in the region of around 75% of the value of the property. Now, what does this mean? This means if you find a house that's worth £100,000, instead of you having to put in £100,000 to buy this house, plus your legal fees and stamp duties and taxes and other stuff, what the bank will do is they will say, okay, well, you put in £25,000 plus your legal fees and stamp, etc., and they will put in £75,000, and they will basically lend you money against the value of the house. Okay, and this is essentially a mortgage, and as I say, a buy-to-let mortgage, they will lend you less, and that's primarily because they're taking security against a house that you do not live in. So it's deemed as a higher risk than personal home, because your personal home you tend to look after better than what you would do an investment property. Okay, so this is the difference between a buy-to-let and a standard mortgage. Now, another difference, hey Kevin, awesome to have you on, by the way. So another difference for you to be aware of is the different types of mortgage. Okay, and what I mean by this is not a buy-to-let and residential. What I mean by this is you get two core types of mortgage. The first one is a capital and interest repayment. Okay, and the other one is an interest-only mortgage. So you get two different types of mortgage. Now, let me explain the difference for you. So if you consider, so I'm just going to flick across to my other screen, okay, and I believe that should be the screen you should be looking at. So if you take a look, a standard mortgage you tend to have, so if you have the value of the house, okay, and the value is 100k, and then the mortgage on this house is, let's say, 75k. Okay, so this is what we call, this is a standard mortgage. Now, the way in which a capital and interest remortgage works, okay, capital and interest repayment, is every single month, let's just say you've got a 5% per year, per annum, per year, that you're paying on interest on that 75,000. So how an interest-only mortgage works, so I'll start with an interest-only mortgage because it's simpler. How an interest-only mortgage works is you would only pay that off every single month. Okay, so whatever your 5% works in at over 12 months, which we can actually work out for those of you that are a little bit interested in the math behind this. So you'd have your 75,000, okay, and then you times that by 0.05, which is 5%, equates to 3,750 per year, and then you divide that by 12, means you'd typically be paying £312.50 per calendar month. Okay, now in interest only, all you would pay is that. Okay, that's all you would pay. Whereas an interest or a capital and interest repayment means you would pay this. Okay, now the calculation for this is a little bit more complicated, but to give you a simplified version, let's just say it's a 25-year mortgage. Okay, what they would do is they'd say, okay, well, your 75K divided by 12 months, then divided by 25 years, or 25 years and 12 months. Okay, so if we do that on the calculator, so I'm giving you a simplified version. If you want to do this properly, there's an amortization calculation. So you can actually find that online, amortization calculator. It'll give you a better idea, but this is just to give you a simplified version of how it works. So you have your 75,000, you divide that by your 25 years of the length of your mortgage, divide that by 12 months, equals £250. So what this would do on capital and interest repayment would be £250 plus 312, which would mean it would be £562.50. Now, the reason it's slightly different is this will be your interest payment on the first month, but then this amount, your 75,000, will go down by £250, which means your interest amount would be slightly less because it's 5% on 74,950, or sorry, 74,750. I hope that makes sense. Okay, so when it comes to your personal homes, when it comes to your personal investments, let me just switch you guys back quickly. Okay, when it comes to your personal investments, what you'll tend to find is the mortgage that you'll typically use for your own personal home. Hey, Asbinder, awesome to have you on, buddy. For your personal home will be a capital and interest repayment because that's what most mortgage lenders prefer. However, if you take a look at your investment properties, the vast majority of lenders prefer you to be doing interest-only payments. Now, there's a couple of benefits to doing interest-only payments that we do go through on some of the other videos. But the most important is the fact that the property value increases over time, which obviously many of you will know while listening to this. Feel free to look at records. If you take a look at the historical record of property values as an average across the UK over the last 50 years, you'll very quickly see that the value of the property increases, but the value of the mortgage does not. So if you had that £75,000 mortgage and £100,000 value, as the value continues to go up, the value of the mortgage stays the same, and therefore the percentage debt you have on the property decreases through time. Okay, which is why I love interest-only mortgages, and I refuse to go on capital and interest repayment, because on capital and interest repayment you are sacrificing your income. Okay, because of course investment properties are based on income. You're sacrificing your income in turn for actually paying down the debt, which makes no sense whatsoever because it is being paid down through being eroded through time anyway. I hope this makes sense. If not, please feel free to drop a quick message in the chat box or in the question box. I'm more than happy to answer any questions you'd like. Okay, so that's the difference between interest only and capital and interest repayment. Next would be a question about when would you actually apply for a mortgage? When would you try and get a mortgage? So if you already own a property that you live in, okay, you would not get a buy-to-let mortgage, you would get a residential mortgage. Whereas if you are moving out of your property into another property, okay, and this no longer becomes your primary residence, you would then apply for a buy-to-let mortgage. Adversely, or inversely, however you want to say it, whenever you go and invest and try and buy a second property that you are not to live in, okay, so you're going to stay in your primary residence and you're going to buy another property that's not for you to live in, if you wanted to leverage the banks, which I'd always recommend, okay, if you wanted to leverage the banks, at this point you would also apply for a buy-to-let mortgage. Now, the way in which you apply for a buy-to-let mortgage, a lot of people have fear and anxiety and concern about the complexities behind it. It's really not that tough. There's a little bit of paperwork, a little bit of a pain in the butt, but this is why you tend to utilize the skills or the strengths and the knowledge and exercise of someone like a mortgage broker. Now, please understand that not all mortgage brokers are made the same. I urge you, never use the mortgage brokers inside the estate agents that you bought the property from, ever. Okay, what you tend to find is there's two different types of mortgage brokers. You get tied mortgage brokers, which is mortgage brokers that are tied to a certain lender or a certain batch of lenders, or you get whole of market. Now, whole of market mortgage brokers have the ability to access the entire market. Now, let me be clear, just because they are able to does not mean they do. Okay, so some mortgage brokers are better than others. As a matter of fact, a lot of them are terrible. Okay, so my suggestion when picking a mortgage broker is make sure you pick someone who comes tried and tested and recommended by somebody who does this on a regular basis, not the estate agent. Let me be clear, not the estate agent. Okay, so you speak to your mortgage broker at this time, and your mortgage broker, if he is good, okay, will get you to complete something they call a fact find. Now, a fact find is where they request certain information about you and information about the property that you are looking to buy. Off the back of that information, they will then go and look at all of the mortgage lenders available, and those mortgage lenders will then be able to say, yes, this is our criteria, this is what we can offer, blah, 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 blah. And there's be a whole list of different mortgage lenders that say that they are a fit for you. Okay, the mortgage broker will then look at all of those, and they will give you their recommendation on what they believe is the best for you at that time, depending on what you are looking to do with the property. Now, if you're looking to buy and refurbish the property, now you're probably going to be buying on something called bridging finance, which is basically high interest lending, but they don't mind lending on properties in need of works. Okay, this is serious work, not like I just gave it a lick of paint. This is serious work, like damp work or replacing kitchens and bathrooms, etc. Okay, whereas if you're buying a house and you're just going, look, this is a turnkey investment, it's ready to go, I just want to buy it and rent it out, I'm going to make my money, I'm going to keep it for 5 years, then you're going to go with a normal mortgage broker or normal mortgage lender, buy-to-let lender. Okay, if you're doing things a little bit more explorative, things like serviced accommodation, which is like holiday lets, or HMOs, which is renting the house out each room at a time, okay, then you're going to be using different types of finance. It's not going to be standard buy-to-let mortgages in the most part. Okay, and once the mortgage broker then aligns this entire list, they're going to present the list to you, and they're going to say, right, okay, so this is all of the lending options, this is my preference. So there's a few things you need to be aware of when it comes to mortgage lenders. Okay, so first of all, you've got your interest rate, your mortgage interest rate. So this is the percentage that they will be charging you every single year in terms of interest. And they will have a fixed period, at which time then they move into a tracker or flexible. There's a whole bunch of terms that they use, but essentially their rates then change and move and adjust according to the market. So what they tend to like to do is they tend to tie you into a 2-year at a lower rate, and then as soon as you come out of that, then it boosts up to a much higher rate. And then what they do is they also then charge you extra fees for getting the finance in the first place, which if you work that out over the term of the mortgage, the 2 years before you look to move on to the other rate, that will then give you the true figure, okay, or I think it's RRP, I can't think of the term that they use, but that's the true figure of what you're actually going to be paying if you level out those fees across the 2 years. Okay, now that's the figure you're really interested in. So the way in which you work that out is you take a look at not only their interest rate, okay, and their fixed term, so let's say their fixed term is 2 years, okay, so their interest rate, then their mortgage setup fees. So they will have a fee that they charge you to set up the mortgage, whatever that is. That might be a percentage of the loan, or that might just be a fixed amount. Okay, valuation fees, legal fees. There's a whole bunch of fees, so stealth taxes they chuck in here. Some lenders will give you free valuation, some lenders give you no fees. So you got a whole array of stuff. Okay, what you then need to do is take a look at whatever that fee is, and you add all those fees together, and then divide that over the term of the mortgage in terms of months. Okay, so let's say it's 12 months, or it's 24 months, so 2 years, or it's 5 years, so 60 months. Divide that across that, add that to your monthly payment, and that will give you your amount that you'll be paying on average every month throughout the term of your mortgage. And do that with all of the mortgage lending options available, and that will then give you a true picture as to who the best lender is for you in terms of average cost over time. Okay, so that is mortgage lenders, and that's how you access them, which will always be through a mortgage broker. I urge you, do not try to approach all the mortgage lenders yourself. Firstly, you're really going to struggle because they like to work with mortgage brokers, because mortgage brokers understand how to package the information correctly and hand to the lender so the lender is happier to lend. Secondly, it's going to take you an awful lot of time. It's like calling up every single car insurance company instead of going through a comparison website. Okay, it's illogical, and sure, you might make it or save a tenner, but for the amount of time you invest, you could have earned a lot more than that doing your day job. Okay, unless you don't have a day job, in which case, it's just an idea. So that's essentially a mortgage broker and how they operate, and that gives you a little bit of an insight into mortgage lenders and how they operate. Now, certain mortgage lenders have different appetites, so they might like a lower value house. So some mortgage lenders don't lend below 250,000. Okay, some mortgage lenders will go all the way down to the property being worth £50,000. So very, very inexpensive house, and they will lend you based on 75% of that. Whereas, as I say, some will be much more interested in a high area and others won't be. So they'll have a different appetite for different types of lending, and that should become clear in terms of their criteria that they offer, and the mortgage broker should be able to pick those out very quickly. Now, this is where the difference between a good mortgage broker and a bad mortgage broker becomes very apparent. A bad mortgage broker will either not put you with the right people, or not have the right criteria, or not package the information well, and therefore the mortgage application will take a significantly longer time than it should. So a mortgage application, so when you put in for your mortgage application, should take anywhere between 6 and 12 weeks as standard. Sometimes it'll go a little bit higher if you've got a slightly more complex structure, i.e. you're buying in companies, okay, especially when you have companies owning companies that are buying properties, okay, and sometimes it can be a little bit shorter because it's a simpler sort of investment, and the lender might be quick at the time. So you would typically bank somewhere between 6 and 12 weeks, and I'd always urge you aim somewhere around 10, 12 weeks, and then if you get it through any less than that, it's a bonus. It's a nice little bonus, it's a nice little win. Okay, so that is mortgage lenders and how long it actually takes them. Now pitfalls with mortgage lenders. Okay, now this is something that's very useful to be aware of. So when you're investing in property, if you have a mortgage, so let's just say you're living in a house of your own and you've got yourself a buy-to-let mortgage on the house, or vice versa, you're not living in a house, you're renting it out, but you're sitting on a residential mortgage, which is very, very, very common. Okay, a lot of people do this, and it's very cheeky, and it's very naughty, because what it does is it actually breaches the terms of the mortgage with the mortgage lender. This is called being in breach of mortgage terms, or mortgage fraud is what they'll try and pull you up for, because they're saying that you have lied or not updated the data with them as you have promised to do within your agreement. By doing so, what the lender has the ability to do, okay, is they have the ability to do what's called calling the loan, which basically means they then say, look, you're not doing what you're supposed to be doing, we want our money back. Okay, now they have the ability, let me be very clear on this. They can do that, and then they have to go to court, and the judge has to do a big hearing, and what the judge will typically do, not always, don't quote me on this, touch wood, you know, you're not affected by this, but the judge will say, are you receiving your money? And if the bank lender says, yes, we've been receiving our money without missed payments, the judge will in all likelihood, not always, okay, and there is precedent of this having happened, which is why I quote, it's a direct quote from what has actually happened in the court of law, is the judge will probably say, go away. However, although they might not be able to call the mortgage loan, what they could do is they could blacklist you not just with themselves, but also tarnish your reputation with other mortgage lenders potentially, depending on who they're affiliated with. Now, if you are intending on investing in property and taking this seriously, please understand, okay, yours or your company's credit file that you're operating on, and I talk from personal experience, having made a lot of mistakes many years ago, that I am teaching people not to make now. The thing that you need to be aware of is your CV, or your company's CV is basically your credit file. And if you are blacklisted with some lenders, or if you have mortgage applications that have been rejected, if you've got missed payments, anything like that, what you are doing is tarnishing your CV, which then makes it much more difficult and more challenging for you to be able to get mortgage lending or bridging finance, etc. at decent rates. Okay, so my urge to you is make sure you keep your credit file nice and clean and tidy. Make sure you have a credit trail. Okay, so don't do what a lot of people do and go, well, I don't have any credit cards, I don't have any credit because that keeps me clean. Well, all you're doing is you're proving to the lenders, or not being able to prove to the lenders, that you are a good user of credit. A mortgage is credit. And if you are not using any credit, they do not know if you are a good user of credit, and therefore are much more likely to reject you for a mortgage application. So the easiest way to counterbalance this is just have a small little credit card, use it for fuel or food every month, pay it off every month, so that they can see a cycle of credit usage going through your name, which then gives you a significantly higher credit score. Okay, just as some useful insight there. So that pretty much covers everything I wanted to cover off on how to be able to get yourself a buy-to-let mortgage. If you have any questions, now is the perfect time to drop it into the chat. By the way, awesome for you guys tuning in. I really appreciate you guys that are watching this live. For those of you that are catching this as a recording, please do me a favor, just give me a like or a subscribe on the Facebook channel, the YouTube channel, or give me a thumbs up or join our page right there on Facebook. We've got the Katana Training Limited Facebook page, or also Katana Property Channel Facebook group, and Katana Training on YouTube. Please do subscribe, and you can get lots more updates on how to invest in property, how to effectively build your property portfolio, how to create the financial abundance that you would like around you through creating a property portfolio. And for those of you that are interested in learning a little bit more about property, where you want to actually take this to the next level, we are running live trainings, so live 3-day trainings, and they're completely free, so we don't charge any money for the 3-day trainings. You're more than welcome to attend. Our next one's actually running Saturday, Sunday, Monday. So today's date is the 25th of August. So Saturday, Sunday, Monday this week, and it's Tuesday the 25th in 2020. If you are obviously watching this as a recording, please feel free to head over to katanatraining.co.uk. That's Katana training.co.uk. We have abundance of dates on there. You're welcome to register or join us on any of our 3-day trainings. I can guarantee you'll have an absolute whale of a time, and it will be the perfect foundations on how to not just get started with investing in property, how to learn the ropes and the basics, but also learn how to scale your business if you're already investing, how to be able to raise finance through over 20 different ways of, or 20 different sources, and basically have a great time surrounding yourself with a good community of other property investors. That being said, that sort of brings us to the end of the session. I'd like to say a huge welcome, a huge thank you very much for each and every single one of you for taking the time today. And I will switch this out and say goodbye. Goodbye.